All right, you're interested in trying to make money trading or investing. You've done research. Some things make sense, but a lot is still confusing. You're either brand new or you know a bit, but you want to start from the beginning to make sure you didn't miss anything. I understand because I was there and navigating my way out was difficult. Along the way, I made so many mistakes that held me back, and I wanted to make a video series to help investors and traders avoid the same pitfalls. To be clear, this is all just my opinion, and it's only one possibility of many. This is just what has worked for me, but this may not work for everybody. I do my best to provide the best information I can, but I highly suggest seeking professional help with your money. At the very least, seek other opinions and strategies to vet information as well as find where you are most comfortable. And the most important point of all, do your own research. The first video is a starting point. Before you even get set up, what are you getting yourself into? I'll do my best to explain the basics and how to tell if it's even something you actually want to do. Some people find investing easy, but for most of us, the learning curve can be frustrating and painful. But if you stick with it long enough, you'll find something that works for you as well as learn valuable skills that you can apply to other areas of your life. Investing has changed the way I look at the world for the better, and it has helped me develop discipline and confidence that benefit me every day. In my case, going through the pain was definitely worthwhile. If you're planning on investing money yourself, then I highly suggest paper trading for quite a while before using real money. Paper trading means using fake money in a trading simulator or on paper to practice. This will give you a feel of the markets and allow you to make mistakes that don't financially hurt you, because there will be mistakes. That part is unavoidable, and the time it takes to financially recover from those mistakes could be quite a while. Believe me, I wish I'd spent more time paper trading initially. So, getting into it. These are the first 3 points that everyone should consider before investing, in my opinion. Number 1, do not use money you need or can't afford to lose. Number 2, do not use emergency savings. And number 3, pay off debt before investing. Those 3 points are important because the value of investments will fluctuate and you may not have what you need in an emergency. Life takes precedence over investments. Once you've got that settled and you've decided to start investing or trading, the first thing you should ask yourself is, why am I investing? Is it for retirement? An alternative to savings? Is it a side hustle? Or do you want it to become your main income source? Investing for retirement and as an alternative to savings accounts are the most common reasons, and both are good ideas in my opinion. But if you want to make trading your main income source, I'm going to tell you right now that you're going to need a lot of money and it'll be very painful. So I highly suggest making it a side hustle until you've built up a decent amount of money and knowledge. Now, are you going to be an investor, a trader, or both? Depending upon your personality, you may only be suited for one or the other. If you thrive under stress, are disciplined, patient, and have a decent amount of money, you might do well as a trader. However, if you struggle with emotions and function poorly under stress, then trading is not for you. When money is on the line, your self-control will be tested in ways you haven't experienced, and it takes time to mitigate that. Also, the ups and downs of trading are exhausting, and the constant high level of stress takes a toll on your psyche quickly. It's a much more difficult life than people expect, and there is a low probability of success. If you decide to become an investor, you'll still be tested, but nowhere near as much. You'll have the benefit of not needing to look at your investments for long periods of time, which really helps your psyche. When things are going down, it's still tough, but it's an opportunity instead of a loss. Over time, I've developed a mixture of both investing and trading. Most of my money is invested, and I use a little bit of it to make occasional trades. Many market participants use a mixture of both, but a lot of people only trade or only invest. Everyone is different. In regards to investing, there's active and passive investing. Active means you manage your money yourself, and passive means someone else manages it for you. Passive investing is nice because people with more knowledge than you are making tough decisions based on every little thing that moves in the market. But there are fees, and most fund managers underperform the overall market. As for trading, there are generally 2 main types: short-term and long-term trades. Day trading usually means you're trading within a single day, and swing trading means you're holding on for a long period of time. And speculation is referring to high-risk, high-reward investments or trades. Speculative assets, or specs, are based more on hype than fundamental value, and as such, are much closer to gambling than investing. The next thing you should think about is your age and the amount of money you want to invest. The general rule of thumb is the younger you are, the more risk you can tolerate, and the older you are, the less risk you can tolerate. Meaning if you're young, you can afford to make mistakes because you'll have less money to work with and more time to recover losses. If you're older, you generally have more money and don't have as much time to reclaim losses, so it's better to sacrifice some potential gains for safety. If you're under 30, you have a very high risk tolerance. You can have more exposure to equities, which means stocks, versus bonds, and you don't need as much of your wealth in cash. This is the time to make mistakes and learn. Again, I highly suggest paper trading before using real money, and when you do use real money, start with a small amount and then add as you improve. If you're between 30 and 45, you still have a pretty high risk tolerance, as well as decent allocation to specs and growth. This is also the time to start looking for safer investments that have potential for growth, but are more reliable in downturns. Investments like bonds or dividend stocks, for example. At this point, you would still keep more of your wealth invested than in cash. If you're 45 to 60, then you have moderate risk tolerance. You'll still be invested in growth, but should be a little bit more cautious of specs. You can still invest in them, but you don't have quite as much time to recover losses, so the percentage of your account allocated should be less. You can also start moving more into safety for the future and can start building up a cash position slowly. But don't add cash too quickly, as inflation can eat into your buying power over time. Continuing investments are a better way to outpace inflation than taking gains and sitting on the sideline. If you're over 60, you have a much lower risk tolerance. You have moderate cash exposure and should be in safer investments that allow you to retire with sufficient income. In some cases, this means taking profits, and in others, living off payouts from continuing investments. Retiring doesn't mean you sell everything you have and go into cash right then. You still want to be invested to take advantage of general market growth. However, you're sacrificing some growth for safety, as you don't have as much time to make up large losses. The idea is to lock in some gains, but not enough to have them eroded by inflation. A growing issue retirees have these days is not planning for a long enough retirement. We live longer on average now, and it's not uncommon for people to run out of money before death. That is why you don't want to completely exit the market when you retire. Inflation will continue to make things more expensive, and if you don't have any vehicle for growth that matches or exceeds it, your money may not last you as long as you need. As for the amount to invest, the general rule of thumb is to aim for investing 15 to 20% of your income each month. Obviously, that isn't always possible, but shooting for that amount should allow the best balance between your current life and your future. You need to allocate enough to make a difference in your retirement, but not so much that you have no life at all. Also, if you plan on picking investments yourself, some professionals recommend putting your first $5,000 to $10,000 or whatever you can afford into a passively managed fund of some kind. What I mean by that is a fund made up of diverse investments that's managed by someone else and aims to mimic the returns of the general market. This is a hedge against the learning curve inherent to investing. You don't have to do this, but it's not a bad idea. The allocation rule of 100 to 120 refers to how much of your portfolio is invested in stocks versus bonds. To figure out what your allocation to each should be, you subtract your age from 100, 110, or 120. It used to be 100, but as people started living longer, the number increased. Stocks have more growth potential than bonds, but are riskier. This is why I stated earlier that you will need more exposure to bonds as you age. Using the original rule of 100, if you're 30 years old, you'll subtract 30 from 100 to get 70. This means at 30 years old, you'll want to have 70% in stocks and 30% in bonds if you're going by this rule, which again is just a general rule of thumb, not something you have to do. All of these points are generalities and not meant to be absolute. In fact, some financial planners have completely different ideas on these points altogether. These concepts are just rough guides to make retirement planning easier for the average person. In reality, your personal situation will ultimately dictate your allocation and strategies. The next thing I want to bring up might be a bit of a reality check for some: account sizes. The average person has been fed a fantasy that stock traders come into the market with a few $100 or a few $1,000s and turn it into $1 million in 6 months. This is not true. I'm not saying that never happens, because it does, but it's very rare. Not only is it rare, but those people are unbelievably lucky because they had to do it by making multiple extremely risky trades. That being said, don't get discouraged if you aren't able to start with a lot of money. You can still invest with a few hundred or a few $1,000s. You'll just have to think about it in a different way. A small account, in my opinion, is anything under $25,000, because that amount or less is subject to PDT, or the pattern day trader rule. This rule states that if you trade in the US and have less than $25,000 in your account, you can only make a maximum of 3 day trades per week. A day trade means buying and selling the same investment in the same trading day. So if you buy Coca-Cola at 10 a.m. and sell it at 11 a.m., that counts as a day trade. If you own Target and decide to sell some when the market opens and decide to buy it back at the end of the day, that is also a day trade. But if you buy the same amount of Target on Thursday and sell it on Friday, then that is not a day trade. Also, the amount you buy or sell does not matter. The time period in which you buy or sell does. So even if you buy 10,000 shares of a security and only sell 1 in the same trading day, that counts as a day trade. As a side note, this rule does not apply to all investments. At the time of this recording, cryptocurrency is not subject to PDT, and depending upon the broker, some other financial products are exempt as well. This rule was enacted in 2001 as an attempt to protect novice investors from horrific losses during the dot-com crash. It has its pros and cons, but needs to be understood because the penalty for failing to abide by it is a 90-day trading ban. Some brokers stop you from making that fourth trade and some don't. Also, some don't warn you until you're about to sell for the fourth time. When I was a new trader, I was stuck in a profitable trade that ended up losing money because I was forced to hold it into the next day to avoid being banned. If you plan to trade or invest and make money now, it's possible, but it's very difficult to make a living doing it. For this reason, I recommend trading as a side hustle only if you have $25,000 or less. It takes the pressure off, and it's much easier to avoid bad trades. If you feel like you have to make money, you're more likely to try to force a trade that isn't there, and this is a recipe for disaster. I know because I felt that as a new trader. Once I treated my small account as a side hustle, things improved quite a bit. Now, if you have more than $25,000 in your account, then you don't have to worry about the PDT rule. $25,000 to $100,000 is a moderate account in my opinion. It's possible to make a living in this range, but still has its challenges. Losses add up, and risking a few $1,000s here and there can become $50K quickly. So it still requires discipline and experience, but it's doable. $100K to $1 million to me is a large account. This is a much more reasonable account size to make a decent living off of. You also qualify for new financial products, for example, portfolio margin, which is a type of borrowed money you use to trade or invest. As I said before, losses add up, so discipline is still required. However, with more money, smaller moves in an investment yield more gains, so you don't need to take on as much risk to yield acceptable gains. Accounts over 1 million are very large accounts. To me, this is the ideal account size. Not just because it's a lot of money, but because it allows you to take on a tiny amount of risk to make a substantial living. Also, you qualify for even more financial products and services. The last point I want to make before we get into vocabulary is extremely important. There are basically two kinds of traders and investors, those that use a margin account and those that do not. A margin account is an account that uses leverage, i.e. borrowed money, to invest or trade. Leverage is the amount borrowed, and margin is the amount needed as collateral to get the loan. If a $2,000 account has a 2-to-1 leverage ratio, then $1,000 of that money is required as margin. On top of collateral, there's usually a recurring fee to use leverage as well. The reason I bring this up is because investing carries its own risk, and adding borrowed money on top of that can be extremely dangerous. I'm not saying that leverage is bad. I'm saying anyone who uses it needs to understand the risks and use it responsibly. Depending upon what you're trading, leverage ratios can be as high as 100 to 1 or more. In that scenario, you would put up $1,000 to borrow $100,000. So you can imagine how risky that could become if trades don't go well. Usually leverage ratios are more reasonable, like 2 to 1 or 4 to 1. So 100 to 1 is very unlikely for new investors. Still, the borrower is responsible for the entirety of the loan, and if the margin a customer puts up isn't sufficient to cover the losses within a certain amount of time, then the borrower could receive a margin call. This means the lender is requiring that the borrower put up more cash quickly or have their investments sold automatically to cover the losses. Margin can be extremely helpful if used correctly, but it can easily become catastrophic if abused. On the other hand, using your own cash without leverage is much safer. The gains will be slower, but you don't have to worry about a margin call and you aren't paying fees to continue using leverage. In my opinion, that is an acceptable trade-off. I feel that new traders should start off without leverage, and when they improve, consider it then. There's so much to learn about investing that mistakes are going to happen along the way, so why amplify those mistakes? The choice is yours, so make sure you understand what you're getting into if you decide to open a margin account. Once you have everything settled and you're ready to get into it, you're going to need to know the jargon. There's a lot to learn, but knowing some of the basic terms will be helpful. I made a short list that will hopefully help you visualize the structure of the market and help you understand some commonly used terms. If you're new to investing, this might seem overwhelming, but don't worry about remembering it all right now. Just immerse yourself in it and you'll be surprised by how fast you pick things up. You can always use this video as a reference point as well. Alright, getting into it. First off, what is an asset? An asset is a valuable resource, any valuable resource. A financial instrument is a contract representing monetary value. It's a broad term. And a security is a financial instrument used to raise money. There are two main types of securities: debt securities and equity securities. Debt securities are borrowed money to be repaid, which would be bonds. Equity securities are ownership for the holder, i.e. stocks. So what exactly is a stock? A stock is a security representing partial ownership in a company. Companies sell stock to raise money for their business, and buyers purchase stock to own a fraction of the company, which entitles them to portions of the company's assets and profits, as well as the right to vote on company decisions. The most common reason investors purchase stock is because they anticipate the value will increase. There are two main types of stock: common shares and preferred shares. Common shareholders get voting rights, fractional ownership, and dividends, but have a lower priority and possibly smaller share of profits. Preferred shareholders still have fractional ownership, but they have no voting rights. However, they have priority over common shareholders on dividend payouts as well as the sale of the company. They may even be entitled to a larger share of the profits as well. A share is an individual unit of stock, as if you're buying 1 share or 100 shares. Shares outstanding means the total amount of shares. The float is the number of shares in public circulation. Market cap, short for market capitalization, is the total value of the shares combined. You might hear companies referred to as mega, large, mid, small, or micro cap stocks. That's referring to the size of the company compared to other companies on the stock market in terms of its share price. For example, at the time of this recording, Apple is a mega cap stock. It's the largest company on the stock market with a market cap of $2.3 trillion, meaning if you added up the value of all the shares as of market close on October 6, 2022, it would equal $2.34 trillion US. Market cap fluctuates constantly as stock price changes. Regardless of how much the business actually costs in physical terms, market cap is usually the metric by which companies are valued. So what is a bond? A bond is a security representing debt. Bond sellers are borrowers who use the bond to borrow a lump sum of money now and pay it back later. Bond buyers are the lenders who lend out their excess cash to earn interest. A bond isn't a traditional loan, but it's essentially a loan. It's a loan that's tradable on an exchange. And just to be clear, when you're talking about a loan, principal is the amount of the loan and interest is the cost of a loan. So what is cryptocurrency? Cryptocurrency is digital encrypted currency in which transactions and records are maintained by a decentralized system rather than by a centralized authority. A derivative is a financial instrument that derives its value from an underlying asset. For example, options. Using our example of Apple again, Apple options trade based on the value of Apple stock itself. That's why it's called a derivative, because it derives its value from something else. And Forex means foreign exchange, which is currency trading. When you hear something about the US dollar going up or down, this is what it's referring to. And to give you some perspective on the structure of the market sizes from biggest to smallest are the derivatives market, which is massive, the Forex market, then the bond market, then the stock market, and finally the crypto market. The reason I mention this is because sometimes money will move between markets, which can affect the financial instruments in those markets. And it's necessary to understand that when you start investing. Now, how are you going to physically interact with the market? You're going to do that through your stockbroker. A stockbroker is an entity that buys and sells stocks on behalf of clients. So if you sign up for Fidelity or TD Ameritrade or any of these platforms, you're going through a stockbroker. A brokerage account is the account you have with that stockbroker. It's essentially a bank account, but it allows you to buy and sell financial instruments as well. The platform will be the interface or the application used to make investments. So if you log on to E-Trade and open an account with them, using their web browser will be the platform. An exchange is a marketplace in which financial instruments are traded. That's where your broker will go to fulfill your order. Now, a portfolio is a collection of investments held by an entity. So if you buy stocks, bonds, or any other financial instruments, those will be in your portfolio. Holdings are the contents of the portfolio, which would be those bonds or stocks. Your position is the amount you have invested in a particular holding. For example, if you own Apple, the amount you hold would be your position. And your average is the average cost of a position. If you buy stock at 50, then it trends up to 100 and you buy the same amount again, your average becomes $75. That would be your break-even point. Anything above that point, you're profitable. Anything below it, you're losing money. Your average is a very important number and will ultimately dictate how much you earn or lose. Now, a fund is a pool of money to be used for investments. For example, a mutual fund. An index is a group of investments designed to show the performance of a market or sector. The S&P 500 is an index of the 500 biggest companies in the United States. It's generally used to show the overall health of the US market. An index fund is a fund investing in a group of securities designed to mimic the movements of an index. An ETF is an exchange-traded fund, a fund that trades like a stock on an exchange. Instead of having to go sign up for an index fund, you can just buy a share of one on the stock market. Now, a dividend is a distribution of profits to shareholders, usually quarterly, but sometimes on other time frames too. Yield is the amount of the dividend. Price action is the continuous movement of price. During trading hours, price rarely sits still because buyers and sellers are moving orders around to try to get the best deal possible. Volume is the total amount of shares traded on any given time frame. And volatility is sharp, unpredictable movements in price. The VIX is the volatility index, or the fear gauge. It's a measure of S&P 500 volatility, which is usually considered general market volatility. In plain English, it tells you how certain or uncertain investors are about the direction of the market in the near future. So there are many different types of stocks, but these are some of the ones you might see the most. A blue chip stock is a large company with an excellent reputation. For example, Coca-Cola. It's been around for a long time, and it's had positive returns for decades. Income stocks are stocks that pay regular dividends. Growth stocks are stocks that grow as fast or faster than the overall market, and generally have lots of room to expand in the future. Defensive stocks are stocks that are unfazed by economic conditions and are generally preferred when the market drops. Cyclical stocks are stocks that grow quickly during a market boom, but also fall quickly during a market bust. Value stocks are stocks that appear underpriced compared to their fundamental value or to their peers. Penny stocks are stocks valued at less than $5. Speculative stocks we covered earlier and are generally high-risk investments and closer to gambling than investing. Generally, penny stocks are considered speculative stocks, but not all penny stocks are speculative. Now, some basic terms you're going to hear all the time are bullish and bearish. Bullish just means that prices are increasing, and bearish just means that prices are decreasing. A bull market is a market that continues to go up over time, and a bear market is a market that continues to go down over time. You'll also hear long and short. Long just means buying to own, for example, buying a stock. And short means borrowing to sell, meaning you're borrowing a stock to sell now because you think prices are going to drop, so that when they do, you can buy it back cheaper and return it to keep the difference. You'll also hear intraday and interday. Intraday means in the same day. Interday means over multiple days. So an intraday trade means that I bought it at 11 o'clock and sold it at 12 o'clock. An intraday trade would be I bought it at 11 today and I sold it at 11 the next day. This next slide shows some of the entities that actually make the market work. The NYSE is the New York Stock Exchange. It's the largest stock exchange in the world. The NASDAQ stands for the National Association of Securities Dealers Automatic Quotation System. It's a tech-heavy exchange, and it's the second largest stock exchange in the world. Don't worry about memorizing the acronym. All you need to know is NASDAQ. OTC stands for over-the-counter, which is where companies that don't meet the minimum requirements of major exchanges trade. These are usually smaller companies, startups, or companies that are financially in trouble. The CBOE, or CBOE, is the Chicago Board Options Exchange. It's the largest options exchange in the world, and it owns the VIX that I talked about earlier. The CME is the Chicago Mercantile Exchange. It's the largest commodities exchange in the world, and it facilitates clearing and settlement of transactions. And just as a side note, commodities are basically raw materials or components that the market treats as equal, regardless of who produced them. Examples would be things like crude oil, steel, and sugar. In our final slide, we're going to talk about some of the entities that regulate the market. The SEC is the Securities and Exchange Commission. It regulates the securities market for the most part. The CFTC is the Commodity Futures Trading Commission, which regulates the derivatives market. The FTC is the Federal Trade Commission, which regulates business competition and consumer protection. The Fed is the Federal Reserve. It's the U.S. central bank. It's an independent regulator of the monetary system. And the U.S. Treasury is the U.S. government department responsible for managing federal finances. All of these organizations play a big role in the market, so it's good to know who they are and what they do. That brings us to the end of this video. Part 2 and 3 will be out soon, and we'll be focusing on setting up a brokerage account, learning how to actually place a trade, and forming your own investing or trading strategies. On a final note, I make investing sound a bit more painful than it really is. That's because I struggled so much at the beginning, and I chose a difficult path. But not everyone has to take that same path, and I hope to help investors avoid some of the mistakes I made. I highly suggest looking for as many differing opinions as you can and pulling the best common themes from all of them. I don't know everything, and neither does anyone else, so keep that in mind when you consume financial content. But if you really want to do this, you will get it eventually. You just need to stick to it, don't get too caught up in any story you're told, and be careful with your money. That concludes Introduction to Investing Part 1. I'll see you in Part 2.